Coming up today, stocks continue their bounce back, on track for the best Thanksgiving week since 2012. Signs that hedge funds bought the dip, a look at the latest holiday spending data, odds increase of a US national Bitcoin reserve, a groundbreaking AI study from MIT, and get ready for what's coming next. It's beginning to feel a lot like Christmas, guys. Let's go. And welcome back, Optimist, to your favorite finance channel on YouTube. Click Capital. And if you like making money in the stock market, then go ahead and click that like and subscribe button. And these daily videos will show up in your feed, and I'll continue to share with you the best opportunities to be found across the market. As we're actually on track for the best Thanksgiving week 13 years since 2012, continuing to see a broad-based rally this week. Really good technical signs across the board after last week's elevated fear. We've got the S&P 500 index reclaiming the 6,800 level after my proprietary oscillator hit oversold level late last week. And just looking at my sector trends indicator, quite bullish across the board. We've got volatility, bond yields, the dollar and inflation expectations trending down with a broad bounce across all stock sectors, which is a good sign to see. And even though the Mag 7's bounced back this week, it's actually been more of a story of a broad-based bounce. We can see that in the equal weight S&P 500, in mid caps, and especially in small caps, the Russell 2000, once again, the leading index today. After that really good bearish to bullish flip last week, shook out a lot of people, and now we're seeing some sectors like retail stocks rip up really hard, leading this bounce higher, which is great to see going into the holiday spending period. And stick with me today because I'll show you some stats on this soon with some real-time data from Adobe. And we're seeing quite a few hot growth stock put in some good gains today. Robinhood up over 10% after they just announced plans for a new futures and derivatives exchange to expand their array of prediction contracts, getting into prediction markets in a big way. Seen a nice bounce back in AI and robotic stocks as well. One we hold in our portfolio, Symbiotic, after coming out with a blowout earnings yesterday, announcing a new client, something the market's been looking for as they're heavily leveraged to Walmart. They're involved in warehouse automation. Stock was up another 12% today. And some pretty good signs in the crypto space that are still very heavily oversold. Getting another nice little bounce here in Bitcoin with signs of a potential bottom being put in. Doesn't mean we can't get a retest or double bottom, as we haven't seen that face ripper of a green candle yet across all growth assets, crypto included, putting in an undeniable bottom that cleans out all the shorts and bears for good. But that could still happen soon. The market is closed tomorrow for Thanksgiving, so crypto will be the only thing trading, and Friday is a half a day for the stock market. Closing early at 1 p.m, usually on thin liquidity that day, as a lot of trading desks are closed, which can sometimes exacerbate moves. But we're seeing some really good technical signs for small cap growth stock. Just looking at the relevant ETF today, big volume coming in on this bounce this week. Good thrust signals across the board, and our stock picks portfolio is having a huge week. Congrats to all those who took my advice and joined last week and bought the dip, some of which have said they've already recouped the cost of membership. But stick with me today because I'll show you why I don't think it's too late to jump on board, as we've seen a strong bounce back across all sectors this week. That's a really good technical sign. We went from 1 week ago, a strong narrative that the AI bubble has burst. We're on track for the worst November for stocks. It's the global financial crisis. Now all of a sudden, we're on track for the best Thanksgiving week in 13 years, and actually on track for the best reversal ever for the month of November, in tandem with a huge volatility crush, especially up the front, looking at the VIX 9-day index. Thursday afternoon, it got up to 31.3. Here we are today at 13.3. Again, another great technical signal for the market, including market breadth. It's got the 4th day in the row with more than 60% of NYSE stocks advancing. And so to my eye, this doesn't look like some oversold bounce on weak breadth, but a legitimate buying thrust. With the S&P 500 now just about 1.5% from new all-time highs. And it looks like we are going to get a rate cut next month. Retail stocks flying in the face of the whole consumer is weak narrative. And whilst the labor market is still soft, it's not fallen off a cliff, and I think it's right in the sweet spot for getting more rate cuts. Good for the stock market. All of this happening whilst Nvidia, up until yesterday morning, actually had a 20% drawdown from recent highs. Getting a little bounce here today on a good hammer candle formation yesterday. Signs the dip was bought near support. Now only trading at 25 times next year's earning. But apparently this is a massive bubble. Largest company in the S&P 500 is down, but the S&P is very close to highs. That means we're broadening out, which is a very healthy sign you want to see in a bull market. And that's actually something we haven't seen in quite a while. And just looking at one of the hottest AI-related ETFs, like I said on Friday, we got some good bullish signal according to my indicators. DSI went oversold. We had reversal signals firing off on elevated volatility. and peak fear and pessimism, looking at sentiment indicators as well. And like I said back then, there was a lot of hate thrown towards me, your favorite bull on YouTube, which is always a very bullish sign. And so narratives can shift quickly. Like I always say, nothing changes most people's minds like price action, as they're completely hypnotized by it. But just looking across key markets, we've got the 10-year yield just finishing under 4% today, possibly heading down to 3.5%. The dollar index also closing below the big key 100 level, potentially on its way back down. We've got Jay Powell, who's made multiple mistakes over his entire tenure as the Fed chairman, on the way out, and a big-time bull and supporter of the current admin, Kevin Hassett, on the way in. I think this time next year, we could very well have the overnight rate at 3%, who knows, 2.75. I think they're going to run it really hot. And with oil staying low and a soft labor market, thanks to big changes in immigration, not to mention AI and the growing sector of robotics, there could be a lot of room for stimulus and easy money conditions. But what's a little different this time compared to the tariff tantrum back in April was it was really big institutions and hedge funds that were scrambling out of the market, with retail buying the dip, whereas this time, I think because crypto's been hit so hard and retail's really leveraged to that sector, we've seen quite a washout in retail, with signs of institutions and hedge funds buying the dip in a big way this time. In fact, Goldman Sachs said on Friday and Monday, hedge funds just logged their biggest 2-day buying spree in over 6 months, and one of the largest bursts of buying seen in the past 2 years. And with that strong move up off the lows, that does bode well for future return. Looking back in history, when the S&P 500 hits a 50-day low, and then 70% of New York Stock Exchange stock rise during the next 3 out of the 4 sessions, we can see some big average gain. 3, 6 months out, 12 months out, 23% on a 100% win rate, which is way better than average. Like I said, returns coming out of peak fears, once the market finds a bottom and has that big thrust up, can often mean strong returns ahead, even if it is obvious, because so many people have been washed out and they didn't buy the dip anyway. And so we're very close to triggering one of the strongest technical signals out there, a Whaley breadth thrust. That's when the number of 5-day advancing stocks exceeds the number of 5-day declining stocks by a factor of 3 to 1. Again, very close to triggering that. Forward returns are super strong. Basically just shows a powerful move in the market across the board, not just a handful of stocks, especially coming after a washout. But believe it or not, the fear and greed index still smack bang in the extreme fear zone. Still plenty of pessimism out there after so many traders just piled into bearish bets last week. Not because of any big change in the fundamentals, but rather on narrative, sentiment. Michael Burry, portrayed in the movie Big Short, considered a cult hero in finance, was posting how bearish he is on Nvidia and the whole AI boom. Funny to note, he just closed down his hedge fund and started a bearish newsletter, apparently already making millions of dollars from it. But does anybody remember a whole week ago when I shared the latest cover from The Economist with a very bearish connotation of a skier absolutely toppling with his skis shaped as red arrows pointing down, which reminds me of March this year when I shared the same cover from The Economist showing Trump lighting a pile of cash on fire. However, in my opinion, he's the most pro-business and bullish president the country has ever had. And I know me saying that upsets a lot of people, but I'm not saying that because of political affiliation, but rather just based on the facts, based on logic, based on what he's doing to unlock the US economy and market. With a big one yesterday, the Genesis mission, creating a national AI platform, tying the industry together to operate and compete on a national level, in addition to one another. I think it's a great move for everybody and very likely to keep America ahead on the most important race of our lifetimes, and that is dominance and artificial intelligence and the closely linked robotic. Not to mention, we're already starting to see the positive effects of tariffs. Not only didn't we get a huge spike up in inflation, like all the pessimists told us, the economy didn't fall off a cliff, like they told us. There's not a big global nasty trade war, etc., etc. Rather, Americans are on track to get record tax refunds this year and next, in addition to, I think, a torrent of fiscal stimulus, which they have the budget to do since they've been running at surpluses these last few months. And just looking at inflation swaps, for those of you who don't know, swaps are a popular investment banking product, transaction between two parties, just as the name suggests, are basically just swapping payment terms. There's no exchange of a physical commodity or anything like that. So financial institutions, hedge funds, high net worth individuals use them to speculate, hedge, or whatever they want to do. We've seen a dramatic drop in 1 year and 2 year inflation swap rates these past few months. In other words, the market really dialing in expectations of what inflation is going to be over the next year or two after fears spiked them higher earlier this year. And that lines up with the real-time data from the economy showing inflation tracking around 2.3%, which gives the room for the Fed, as confused as they are and as mixed messaging as they've been sending the market, as they're still not sure whether they're backward-looking or forward-looking. Even under the guise of Jay Powell, they could still cut rates next month. In fact, it looks like there's a strong probability, 83% chance that they will. And like I said, with a big time dove coming for the Fed, 3% chance it's going to be Kevin Hassett or whoever it is, very likely to lower rates again. And like I said, run it hot. Really light up the US economy, give it every advantage possible, as America still has the highest overnight interest rate amongst all developed countries and still being able to outgrow them. And so in addition to lower financing costs for small businesses and consumers, on some measures, inflation is also under control, with data pointing to a typical Thanksgiving dinner actually being cheaper this year than last. And even though there's persistent signs of softness in the US labor market, consumer spending is not only holding up overall, but actually growing. Just looking at the latest data from Adobe for the 2025 holiday shopping period. So far this month, total season spend up 7.5% year over year. That is huge, with Adobe forecasting over $250 billion to be spent this holiday season. That'll be the first time US consumers have ever spent more than $250 billion. And again, we're seeing good breadth across all retail sectors, showing more spending this year than last. But the most mind-blowing stat of them all, AI-driven e-commerce traffic. AI is changing how consumers shop for holiday gifts. This holiday season, traffic from AI sources, large language models, that's chatbots, GPT, Gemini, Grok, to retail sites, was expected to rise 520%. However, just looking at the latest data, it's up 830% year over year, which is massive and a huge monetization opportunity, especially for Gemini. Already with millions of advertisers in place, they're referring high commercial value and intent traffic. And you bet your bottom dollar they're going to clip their ticket on that at some point, as we're already seeing signs of them starting to integrate ads into their AI product, along with a huge increase in people subscribing to premium AI services that they offer, including Nano Banana Pro, hands down the leading image generation tool on the web, along with Gemini 3, the leading chatbot. America's largest consumer electronics chain, Best Buy, just increased their sales outlook going into the holiday period. After coming through yesterday and beating expectations on earnings, stocks up again today, along with the retail sector, which is a really good sign for the US economy. And a good point made by Shay Baller today, and something we've been talking about, how the AI boom is different from the internet boom. A lot of people are liking it, think it's exactly the same, but there are key differences. The biggest being in the late 90s, they overbuilt like crazy. There was so much spare capacity. Whereas today, there's actually not enough supply. Looking at a lot of measures, like Nvidia said, they can't sell enough GPUs. That's why they're just printing money at huge margins. And I just don't think that's going to stop all of a sudden overnight. It's been building for not even 3 years really, and we're still nowhere near saturation levels when you look at consumers and businesses' use of AI, along with the increasing use case of AI. And so who knows, this whole AI boom could go further than the internet boom. And I expect US productivity to accelerate, which it already has been outpaced other developed countries for 20 years now, thanks to the internet and America's large focus in leadership and technology. Innovation's basically fallen off a cliff in Europe and the United Kingdom for a number of reasons. Overregulation and taxation being two of the biggest. Now they're struggling with a flight of capital and talent as they slowly but surely turn themselves into a third world country. With further signs of that today on the United Kingdom unveiling significant tax rises going the opposite direction of America. People say American exceptionalism is on the way out, to which I always say, well, who's going to replace them? Because unfortunately, there's a growing narrative over there that they can tack their way out of the problem. But like we're already seeing, a number of wealthy people are leaving. Just like we heard from one billionaire the other day, who just said the British economy is now uninvestable. Even the world's richest man, Elon Musk, just posting today on his social media platform, the current regime is turning Britain into a prison island. Not only an increase in crime, but they're on their way to drowning in social welfare for those that come and look for a free ride, which is actually really sad to see, but just further adds my conviction to America staying the #1 most investable market for many, many more years to come. And especially with the current admin positioning themselves to be the leader in crypto, digital finance, the blockchain, stablecoin, tokenization. Like I said on Friday, I think now is a great opportunity to buy the dip on that. We've got a massive divergence between the NASDAQ and Bitcoin, typically really closely correlated, with Bitcoin being really oversold relative to the NASDAQ, hitting records last week on elevated fear in the crypto market, huge exodus, big flush out, liquidation, margin calls across the board, but the fundamentals have improved a lot over the last year. And that's why I've changed my view on crypto over the last year, along with the fundamentals, as things are very different compared to a year ago when the previous admin was trying to shut it all down. Now we've got the biggest bank in the world, JP Morgan, responding to a big calls for boycott and a little bit of a run with people closing their accounts after they came out against MicroStrategy, pushing MSCI to consider excluding Bitcoin treasury companies from their indices, which MicroStrategy's in their global index and the fintech index. Now they've just come out creating a new leveraged product linked to Bitcoin. But like I've been saying, the fundamentals just keep stacking up. Treasury Secretary Scott Bessent says the Trump admin is removing all regulatory barriers against Bitcoin and crypto. We've got more deregulation coming. We've got the Vice President JD Vance saying Bitcoin will become a strategically important asset for the United States. At the same time, one of the president's sons saying now's a nice time to purchase Bitcoin just a couple of days ago. We've seen this a few times. Kind of hints been dropped here and there, some of which have turned out to be really good calls, with the president himself saying buy the dip in the height of the tariff tantrum. And so it's interesting because just over the last day, we've seen a huge increase in the odds that we see a US national Bitcoin reserve by the end of next year, now at 56% chance. And so I think now would be a great time for the US government to buy the dip on Bitcoin. Or if we did retest down to those $80,000 lows that we saw late last week, not only would it help support the market, it could be doing taxpayers a solid by buying the lows instead of the highs. And so that could put a very important backstop, the biggest buyer in the world, behind it. And just the thought that that's coming could be enough to give us the mother of all rallies once Bitcoin does find its feet again. And Ethereum could very well be included in a strategic reserve as well, as it has even more use case for the future of finance and digital transactions with stablecoins and tokenization of real world assets as well. Plus, we just got a big pending change for the plumbing on Bitcoin options, the largest Bitcoin ETF, the BlackRock under ticker symbol IBIT. The Nasdaq's going to move them into the same regulatory class as the largest, most liquid equities on earth. They're raising the options limit from 25,000 contract to 1 million. That means as it currently stands, hedge funds, institutions, whatever, can only open a max position of 25,000 options contracts. So a 40x increase allows for some bigger players to come in, make some bigger trade. And this is the same category that mega cap tech stocks and the largest ETFs now hold. And that's because its asset size and liquidity justify bigger option trade limits. So that definitely allows the potential for bigger trades to come into the market. And again, just like in stocks, we've been seeing signs of big money and whale buying this dip more so than retail. In fact, even more than back in April. The amount of whales versus retail buying. A lot of retail traders use leverage on margin. They've had to find out the hard way. That can often end in disaster. Even during a bull market, prices only have to pull back 20, 30% or 35% like Bitcoin just did. You leverage 2 to 1, 3 to 1. It's a devastating or complete and total loss. But that washout creates fertile ground to buy the dip for those that have the spare cash and willingness to do so. Just moving on to one of the hottest trades in the market at the moment, Alphabet Google. Now getting heaps of bullish headlines and sentiment, traders big and small piling in, finally recognizing its strength, Gemini 3 leading the charge in AI, Warren Buffett's company getting into the stock. However, I think it's now been got, especially on these headlines. Google stock's been the clear AI winner, and the gains could keep coming. As we've now gone from memes of Google being the ignored elephant in the room to now Gemini leading other chatbot in terms of scoring and recent growth rate. And look at that charge higher and Alphabet Google's market cap, 3.9 trillion, hot in the heels of Nvidia. And I'd say if that does happen in the coming weeks, month or two, that would be a little bit of a take profit signal for me. Not completely selling out, but like I said yesterday, nothing wrong with taking a few shares off the table, locking in some profits, selling into crowd mania, the recent pylon there's been into this stock. Because just looking at a spread chart of Alphabet Google versus Nvidia, definitely technically oversold here, getting some bearish reversal signals. So not a bad time to lock in a few profit, even on a long-term position, which I have just done myself as well. But don't rule Nvidia out just yet. No doubt Google TPUs are a bit of a competitor, but Nvidia's GPUs are still the gold standard. Jensen Huang still has the world's richest men lining up to buy the picks and shovels of the AI boom with this cool image here, actually generated by Google's Nano Banana. The most realistic images any AI model can create now. And I think it's safe to say we're now reached that level where it's very hard to distinguish between a real image and an AI image. Obviously, it's easy to tell this one's not real given the context, but some other ones, you really can't tell whether it's real or not. And so a lot of people are underestimating what's coming next. And as I've been saying for a couple of years now, instead of ignoring it or hating it, learn to use AI, become an early adopter, embrace it, participate, own shares in ETFs set to benefit from this structural wave. MIT just came out with a groundbreaking study today, finding that AI can replace 11.7% of US workers already now, representing $1.2 trillion in wages. We're already seeing this huge disruption. Not even tech companies, but even retailers finding ways to slow down their payroll growth and replace them with chatbots and warehouse and factory robot. You'll notice it yourself whenever you call a large company. You're most likely speaking with a chatbot to start with. McKinsey just came out yesterday, took it a step further, said AI could replace half of the work carried out by American work. Artificial intelligence and robotics could automate more than half of all work carried out by US workers with existing technology. And so no doubt we're on the cusp of big changes in the world. And how all this plays out socially and economically for millions of low and middle income consumers is still yet to be seen. But one thing's for sure, it should be hugely beneficial to the AI and tech companies and shareholders alike. And I think that's why it's important to bring more people into capital market. And hopefully as part of stimulus next year, we see incentives for young people especially, many of whom feel disenfranchised from the capitalist system, to start owning stock, to learn more about finance. There's a real lack of financial education, which I think is a big part of the issue as well. We're not really taught how to save, invest, taxation, insurance in school. We're kind of all left to our own devices to figure it out as we get older, which for many people, by the time they do, it's already a bit too late. And it's nice to hear from a few members of mine who've actually got their kids watching these daily market reviews, and that helps a lot starting early. So I really do hope my content and services helps people better understand the markets and better understand the basic principles of good investing, staying diversified, dollar cost averaging every month, not using leverage, and having realistic expectations of your portfolio, expecting short-term volatility. And so I demonstrate that in real time with real money. With my most popular service being my stock picks portfolio. Every Sunday I send out a deep dive research report into what stock I'm going to buy the next day and why. I explain it all in simple terms and keep transparent performance tracking inside the private members area. You can see all my current positions, exactly how my portfolio is performing, and it's been having a great week. Like I said last week, it was a good time to buy the dip. And since I started this portfolio last year, it is significantly outperforming the Vanguard small cap index fund that we use as a benchmark. Now back to 50% in time-weighted return. But it's not too late to get in because the portfolio hasn't even taken out the all-time high from about 6 weeks ago. But I believe all the ingredients are there for a monster 2026 for small cap stock. I positioned my portfolio in over a dozen secular trends: AI, robotics, healthcare, rare earths, commodities, along with a sprinkle of defensive stock for good measure. I don't use any leverage. In fact, portfolio has almost 8% of the current value in cash, with 36 positions currently being held. So very diversified. And like I said, I buy a new stock every Monday, weekly dollar cost averaging, which helps to create a smooth equity curve, makes it much more psychologically easier to stay invested. And that's the key to successful investing, is staying the course, not getting shaken out on short-term volatility like a lot of people do. And so if you'd like to be a part of that and jump on board with me, then now is your best opportunity to do so. Before our Cyber Week sale ends this weekend, you can lock in a permanent 30% discount by clicking the link below this video, heading to our site clickcapital.io and using promo code BTFD30 at checkout. You're welcome just to test the waters with a monthly plan, or if you want to commit long-term for the biggest savings, you can use the promo code on a lifetime plan and just pay a one-time fee with no ongoing costs. And if you'd like to jump on board our other services, you can also use this promo code on a package deal. And so now's your chance to jump on board. I encourage you to take advantage of this opportunity before it closes in a few days, as the markets close tomorrow for Thanksgiving. And I just want to give thanks to all my supporters out there from all around the world who watch these videos every day, even including the trolls and the bears. Thanks a lot, guys, for helping this channel grow and have a great year. And especially a huge thanks to my loyal members who make all of this possible. I hope you guys have a great holiday tomorrow, and I look forward to seeing you back here come Friday night. Cheers.